All right, let's talk about Campbell's. Their latest earnings report just dropped, and on the surface, it looked pretty good. They even beat expectations. But then the stock just cratered. So what exactly did Wall Street see that the headlines completely missed? Let's break it down.
Okay, so here's how we're going to tackle this. First, we'll look at those headline numbers. Then we're going to deconstruct the quarter to find the real story. After that, we'll get into management strategy, see what the market thought about it, and finally, we'll give you the next call, our take on what it all means for the stock going forward.
And this really is the central mystery, isn't it? Campbell's comes out, posts a beat on both the top and bottom lines, and yet investors just ran for the exits. We're not talking about a little dip here. This was a serious sell-off, so let's get into it. First up, let's just look at the numbers that everyone sees first. You know, the ones that might make you think everything's actually going pretty well.
So here's the good news, right? Adjusted earnings per share came in at 77 cents. Now, Wall Street was looking for something closer to 73 cents, so this was a solid beat. On paper, that's a check mark in the positive column.
But, and this is a huge but, here's our first clue. That same 77 cents per share, while beating this quarter's estimate, was actually down a painful 13% from the 89 cents they pulled in this time last year. See, a beat today doesn't just erase a double-digit decline from yesterday.
And you see the exact same story playing out on the top line. Yeah, sure, revenue of almost $2.7 billion just squeaked past the estimates, but their reported sales were down 3% from last year, and even their organic sales, which strips out some noise, were down 1%. The theme here is pretty clear. They're beating some really low expectations, but the business itself is still shrinking.
So it's obvious those headline beats were masking some fundamental issues. We have to peel back the layers here, look past the press release, and dig into the actual numbers to see what really spooked investors.
This chart really just visualizes the pain. It's like a waterfall of negative year-over-year numbers. And notice how the drops get steeper as you go down the income statement, from sales to operating profit to earnings. That tells you the company's profitability is actually eroding even faster than its sales are. That's a bad sign.
And here it is, the main culprit, a 150 basis point drop in adjusted gross margin. Now, for a giant consumer staples company like Campbell's, that is a massive hit. It literally means for every single dollar of soup or crackers they sell, they're keeping 1.5 cents less than they were a year ago. That adds up fast.
So, why the collapse in margins? Well, it was basically a triple whammy. You had your general cost inflation, ongoing supply chain headaches, and now tariffs, which management actually admitted are hitting about 4% of their total product costs. They're just getting squeezed from every direction.
And this just shows you the weakness wasn't in one little corner of the business. Both of their big divisions, the core meals and beverages, and the snacks division, which is supposed to be their growth engine, both saw sales fall. The problem wasn't just one bad product, it was a broad-based drop in what people were buying.
Okay, so with sales shrinking and margins getting crushed, what's management's game plan? Well, they laid out a strategy that is clearly built for defense, not offense. This is about survival.
Their plan really rests on three main pillars. First, get super aggressive on cutting costs. Second, make a really strategic acquisition to protect their crown jewel brand. And third, just manage expectations by basically telling investors, hey, don't expect a miracle anytime soon.
Now this is the most interesting move they made, the La Regina deal. This is the Italian company that's been making the sauce for Raos, Campbell's superstar premium brand, for decades. By buying a huge piece of their own supplier, Campbell's is trying to protect its single biggest growth driver, make sure that quality stays high, and, capture more of the profit for themselves. It's a smart defensive play.
But even with that move, just look at the guidance they put out for the full year. Organic sales, flat at best. And then you get to the profit lines. Adjusted operating profit down 9 to 13%, and adjusted earnings per share down a staggering 12 to 18%. Management is telling the market loud and clear that the pain from this quarter is probably going to continue all year long, and for an investor, that is not a reason to stick around.
On the earnings call, the CEO said performance was in line with our expectations. The thing is, the market's reaction suggests that investors have very different expectations for where they put their money.
And here is the verdict, right here in black and white. A 5.2% drop in the stock price on the day of the news. But look at the volume. Almost 19 million shares traded. That is 3 times the normal daily average. This wasn't just a few nervous people selling. This was a major institutional reset. The big money decided they'd heard enough and got out.
This slide just captures that massive disconnect perfectly. Management says in line with expectations, but the market hears, wow, your expectations are terrible. Management talks about mitigating tariffs, but the market hears, your margins are getting absolutely crushed. Management says the year is on track, but the market hears, on track for a double-digit earnings decline. It's two different languages.
And let's be clear, this wasn't some isolated incident. Let's just zoom out for a second. Over the past year, while the broader consumer staples sector has been basically flat, Campbell's stock has been obliterated, down 34%. This earnings report wasn't the start of a problem. It was just the latest chapter in a long story of serious underperformance.
So, after digging through the numbers, the strategy, and the market reaction, where does that leave us? What do we do from here? This is our take on Campbell's stock right now.
Based on all the evidence from this quarter and the outlook they provided, our rating on the stock is underperformed. We fully expect it to lag its peers and the broader market.
Look, our thesis here is pretty simple. We don't see that volume pressure easing up anytime soon. Consumers are still being really careful with their spending. There's no obvious near-term catalyst that's going to fix those crushed margins. The turnaround in their vital snacks business is still a show-me story. We have to see it to believe it. And yeah, the La Regina deal is smart, but it's just not big enough to fix the fundamental issues across the rest of this huge company.
And all of this brings us to the final, critical question for anyone looking at this stock. With the share price down so much, does it actually represent a bargain? Or is it a classic value trap? You know, a stock that looks cheap but is only going to get cheaper because the business itself is still getting worse. That's the billion-dollar question right there.
This is not financial advice.